So, the latest jobs report dropped, and at first glance, the numbers looked absolutely incredible for the US economy. I mean, a huge beat, way bigger than anyone predicted. But then the market's reaction told a totally different story, basically killing any hope for a rate cut this year. So, let's break down what the markets are seeing that maybe the rest of us missed. Okay, so here's the big number that flashed across everyone's screens: 178,000 new jobs. Now, to put that into perspective, most economists, they were only expecting around 59,000. So this wasn't just a beat. It was a massive, triple the forecasts kind of blowout. In fact, it was the strongest month we've seen in over a year. And this is where we get to the central puzzle. You see a number that's strong, and you'd expect a wave of optimism, right? A sign that, hey, maybe the Federal Reserve has some breathing room to ease up on interest rates. But nope. Bond traders did the exact opposite. They pretty much slammed the door shut on any rate cuts for 2026. So, why? Well, the market's reaction is our first clue. We have to look past that incredible headline number. This wasn't some random freakout. It was a very calculated response to some pretty serious warning signs that were kind of hidden just beneath the surface of this report. I mean, this slide really shows you the sheer scale of the surprise. Just look at that non-farm payrolls line. Analysts were bracing for a modest 59,000 jobs, and the economy came back with 178,000, all while the unemployment rate held perfectly steady at 4.3%. On paper, this looks like a rock-solid labor market. Or so it seemed. Right, this is where the story starts to get a lot more complicated. Because as soon as you look under the hood of this report, you start to see why all that optimism just evaporated. The foundation just isn't as strong as that one big number makes it out to be. And here is the first major red flag. This is wild. While the economy added those 178,000 jobs, a staggering 396,000 people left the workforce. They just stopped looking for work. So that stable unemployment rate, it wasn't because of a booming job market. It was because a huge chunk of people just checked out. And that is not a sign of a strong economy. Okay, problem number 2, wages. Now, wage growth has slowed to its lowest point since 2021, which, is normally good news if you're trying to fight inflation. But here's the catch. It's not slowing down nearly enough to solve the Fed's real headache, which is that inflation is still stubbornly high. So it's like a small victory in a much, much larger battle. And this chart does a brilliant job of showing just how narrow these job gains really were. Check it out. Healthcare, all by itself, added 76,000 positions. That's almost half of the entire total. This wasn't some broad-based boom across the economy. It was super concentrated in one essential sector, which kind of points to an economy that's just running on essentials, not a dynamic, expanding one. So the crucial takeaway here is that once you piece it all together, you've got people leaving the workforce, you've got sticky inflation, and these super concentrated job gains. It becomes really clear that the big headline number was masking some real weakness underneath. And as if all that domestic data wasn't complicated enough, there's a massive external wildcard we have to talk about. The ongoing conflict in Iran is casting a really long shadow over the entire global economy, and it's making the Federal Reserve's job incredibly difficult. You see, the conflict is creating a serious risk of something economists absolutely dread: stagflation. It is the worst of all worlds. You get a slowing economy, but prices just keep going up and up. And for a central bank, an environment like that leaves you with literally no good options. And here is the trap the Fed finds itself in. The war is pushing energy prices higher, which has already forced the Fed to raise its inflation forecast for the year. Now, if they cut interest rates to help the economy, they risk inflation just spiraling out of control. But if they keep rates high, they could totally crush a labor market that, as we've just seen, is already showing some pretty serious cracks. But believe it or not, there's an even deeper, more fundamental shift happening that we really need to understand. This might be the most important part of this whole story, because it completely changes how we should be interpreting these job numbers. The old rules are literally being rewritten as we speak. Yeah, the way we've all been taught to measure a good jobs report for decades, well, according to some new research, it might be completely wrong now. So get this, it's a real stunner. According to new research from the Dallas Fed, the number of jobs the US economy needs to create each month just to keep the unemployment rate from going up is now close to zero. That's right, zero. So what in the world is this break-even rate?
Well, think of it like the economy's maintenance level for jobs. And the reason it's fallen off a cliff is because of slowing population growth and a huge drop in immigration. There are just way fewer new workers entering the workforce who need jobs each month.
And this changes everything. In this new world, a gain of 178,000 jobs isn't the sign of some red-hot accelerating economy that would force the Fed to act. Instead, it's really just a sign of resilience. It's proof that the market is still functional, but it's definitely not booming. Okay, so let's put it all together. We've got a headline number that looks great on the surface but is actually weak underneath. We've got a major geopolitical conflict brewing, and we've got this new structural reality for the job market. What does all of this actually mean for global markets?
Well, the market has already placed its bet, and it is not even close. Traders are now pricing in a 77.5% probability that the Federal Reserve will not cut interest rates at all in 2026. They believe this combination of sticky inflation and a resilient but not booming job market gives the Fed absolutely no reason to make a move.
And the implications here are global. It means that, for the foreseeable future, U.S. interest rates are probably going to stay right where they are. That translates to a strong U.S. dollar, higher yields on short-term government bonds, and just a generally more cautious environment for riskier investments all around the world. You know, this quote from the source material really just sums it all up perfectly. The Federal Reserve's preferred move right now is to just wait and see. They do not want to act. But the thing is, they might not have a choice. And that leaves us with the final crucial question. All the domestic data we've looked at suggests the Fed can probably afford to be patient, but a major escalation in the Iran conflict, whether it's through skyrocketing energy prices or some kind of supply chain chaos, that could be the one thing that forces them to act, whether they want to or not.